When we look at economic growth here in the U.S., we had a very turbulent first half. The first quarter actually saw negative GDP, and that's because of the noise around trade. We saw that then give completely back in the second quarter, and the U.S. produced pretty solid numbers for the quarter. Now, as we move into the second half of this year, we think that noise is going to be behind us, but still that uncertainty is there. We haven't seen the full effects from the tariffs because they're actually now just being agreed upon. What does that mean from the business spending standpoint, from the consumer spending standpoint? What we do know is that the consumer makes up the majority of GDP, and right now the consumer is really sitting here on fumes. The labor market's been solid, but at the same time, consumers have been able to fund this continued spending over the past couple years through the use of credit cards, taking on debt. What we're seeing is that appetite is starting to subside a bit. You're seeing consumers less willing to take on more credit card debt and try and repair their balance sheets. So what does that mean? There's less ability for the consumers to spend money. They surely don't have any of that COVID stimulus left, and now they're trying to reduce their spending habits to bring that credit card debt. In fact, when you look at this chart, you can see that consumer credit, which is the revolving credit that you see in that in the blue line, you can see that consumer credit's been declining on a year-over-year basis. Typically, when you see that happen, you actually see the U.S. enter a recession. We're not yet saying that we're headed for a recession, but we are saying that this does present a challenge for the economic growth numbers. The expectations for economic growth in the second half of this year is below 2% for each quarter. That's much lower than we've been accustomed to. Now, when we talk about the labor market has been strong, but it is slowing, and we're seeing those cracks emerge quite a bit more. When you look at this chart, you're seeing that continuing claims, or those people that are unemployed that continue to file claims for unemployment insurance, has increased to the highest level we've seen since 2021. You couple that with some of the remarks we've seen from companies that they're laying off their workforce. But also, when you look at the number of people that are leaving their jobs voluntarily because the job prospects are so high, that's falling. You're also seeing from a duration of unemployment, this tends to be a leading indicator for the labor market. You start to see people unemployed for longer. This tends to coincide with an uptick in the labor market. So we think this is going to challenge economic growth as we move forward. Now, from a business perspective, businesses are getting some of that certain uncertainty put behind us. But given the fact that we're just now in the middle of this year getting these trade deals settled, businesses are still trying to figure out where they can move their supply chains, where they can redirect their spending so that they can either absorb some of these tariffs or pass them on to consumers. And we think that business spending over the long term for the U.S. economy will be very strong. But over the second half of this year, we think that's still going to be challenged as businesses continue to adapt to this reordering of global trade. And that brings us to the inflation. Where do we see inflation in the second half of this year? Let's be clear, inflation has improved substantially from what we saw in the aftermath of the pandemic, but we are stuck. The progress has slowed, not only because tariffs can be inflationary, but you're still seeing the money supply increasing in this economy. That tends to be inflationary, and the economy hasn't collapsed. Typically, the best cure for high prices is high prices. And we have not seen the economy collapse in the consumer collapse. We're still seeing that continue at a much slower pace, but still continuing on. This leads to concern about inflation pressures. Now let's dig apart inflation and look at this chart. When you look at the service sector, and this is something that the Federal Reserve focuses on because the service sector is where we spend the majority of our money, you can see that services, excluding energy, is coming down on a year-over-year basis, but it's still growing at between 3.5% and 4% on an annual basis. That's not going to help the Fed be able to be super accommodative with monetary policy. So we think inflation pressures are still here. It's a concern. Inflation's much better, but we think that in the second half of this year, we could see some volatility and some upside surprises to inflation.